Welcome to this tutorial. In this tutorial, I will be showing you some of the things you need to know for your XFM examination. Basically, this revision is for the November diet. I'm assuming that you've gone through your notes, you've read all the examinable places in your notes, and you've actually attended lectures, or if you're not attending lectures, at least you've been able to do justice to the notes and your textbooks. And also, I want to assume that you have gone through your Pathfinder, that's the past questions, and you have solved at least a couple of past questions that will help you to be able to understand the examination pattern. But in this video, I will just walk you through some of the areas that I feel are also highly examinable, just to refresh your memory. I may not be laying down the foundation, but some of the technical areas, I will be covering them in this video. So starting from the introduction to financial management, what is the basic concepts behind financial management? The basic concept is that as a finance manager, you want to ensure that a company is able to manage its finance in such a way that shareholders' wealth is not depleted. So let's look at the definition. Definition of financial management is just how organization, how they procure funds and how these funds are being utilized. And the objective of this is to ensure that there is liquidity, profit maximization, and shareholders' wealth also is not destroyed, and also improvement in earnings per share. For a finance manager, there are some decisions that you are expected to carry out. The first is the investment decision, financing decision, dividend decision, and also risk management. So basically, looking at the topic or the course, strategic financial management, it will basically center around your investment decision and your financing decision. However, there is going to be dividend policy and all of that. But for your investment decision, that takes you to investment appraisal and a different method of appraising an investment. So before you embark on any investment, you want to know the profitability or the viability of that investment. After which you now start looking at how to source for fund. How do you raise the fund for the investment? So that will take you to your sources of finance. There are other topics like your right issue, debts, financing, and all of that. So in a moment, we'll be looking at those areas in detail. But for now, just know that for the financial manager, your role is investment decision, financing decision, dividend decision. Dividend decision talks about how much a company should pay out to shareholders to ensure that the shareholders are also happy, and how much should the company retain to ensure that the business also continues to run. Operations are not affected. So that's what the dividend decision is all about. So some companies have dividend policy to say, oh, we are going to be paying 60% as dividend annually, 10% as dividend annually, while some other companies, they don't have a specific dividend policy. They pay as they agree. Okay. So risk management, we're looking at financial risks and also business risk. For a company going into another line of business, the company will be experiencing business risk. So as a finance manager, you want to advise the company adequately to ensure that risk is being minimized. And also for financial risk, talking about how much debt. So you're talking about how much debt should the company take, how much equity should the company also use in financing a project or financing its operation. Then finally is the communication with stakeholders or shareholders. So it's also the duty of the finance manager to ensure that shareholders are updated, but that will be done through the reporting line, depending on the size of the organization and how the reporting line is. Shareholders, these are the owners of business. We'll be wasting time here. So these are the stakeholders of an organization. The first, we have the employees. We have which are the non-management staffs. We have the shareholders, management staff, board of directors, customers, lenders, and suppliers, community governments. So what is the expectation of all of these groups? The shareholders, basically, what they want is steady dividend payment and also capital appreciation. So what does this mean? The capital appreciation here, if the share of the company is 50 naira this year, they expect the share of the company in the coming year to increase. So in a situation where the share price keeps dropping, that means that the capital is not being increased. And as a result, shareholders will not be happy with that. Customers expect reasonable prices and high quality products. Suppliers prompt payment of invoices. Lenders, what are they looking at? The ability of a company to pay interest and also principal repayments. Government, their basic interest is on compliance with taxes. Community, basically what they are looking for is job provision and also infrastructural amenities. Employee expects wages increase or salary increase. Having said that, this set of people, there's always conflict between them, between the management and employees, between management and shareholders, between shareholders and bondholders, and all of this, because the different groups have different interests. For instance, employee may request for increase in wages or salary, while management, on the other hand, may be interested in reducing costs, and thereby they may want to reduce employees' remuneration. Or for the suppliers, they want prompt payment of invoices. If it is 30 days term, they want at the end of 30 days that the company should be able to pay the invoices. But on the other hand, the company may also want to delay payments in order to free cash flow for some other purposes. Customers will desire low price and high quality products. Management may want to sell at higher prices because they want to make higher profits. Management may be too ambitious, thereby investing in risky projects. Shareholders may not be in support of this. So each of these groups always have this conflict of interest. And it's very important that this, in the interest of each of these groups, is being taken into consideration for the company to be run efficiently. So one of the ways in which this conflict of interest is being minimized is to ensure that the company has the code of corporate governance. So the corporate governance helps to reduce risk that comes with agency theory, because when a company has gone, the size of a company has increased, there may be need to now strike a balance. So corporate governance helps to strike this balance so that the directors of a company do not run the company at the detriment of the owners of the company and other stakeholders. So that brings about the code of corporate governance. Now, some of the purposes of this code is to ensure the integrity of financial reporting. If the financial reports are accurate, it's going to create a kind of transparency, visibility of what is happening. The stakeholders are able to see what the inflows are, what the outflows are, and it helps for decision making. Also, separation and balance of power. A single individual in the company should not be so powerful that the person will be the one taking all major decisions. So as a result, the Code of Corporate Governance ensures that there is separation of power within the board. Also, this code is aimed at reducing risk, mitigating risk. This is done through the audit committee and also minimize agency problem, protect shareholders and other stakeholders. These are the basic reasons or the purpose rather of the code of corporate governance. And some of the characteristics include fairness. So management must be fair to every of these stakeholders, not just only to the shareholders. So there should be fairness, there should be accountability. The board should be accountable for their decisions. Transparency, it should be transparent, risk management, responsibility, integrity. So these are the characteristics of the corporate governance code. Let me scroll down to some other area. Let's go to the next chapter. It's just a revision class. So chapter 2 is capital budgeting and investments appraisal. So this forms one of the pillars of the financial management examination, your investment appraiser. Investment appraiser can come in different forms, So, but what is the investment appraiser all about? You're looking at long-term investments, investing in long-term projects. There are two types of projects. We have the mutually exclusive projects and the independent projects. So mutually exclusive projects are projects that cannot be undertaken simultaneously. That means if project A is to be undertaken, project B will be rejected. While the independent projects, these projects serve different purposes, and as a result, they can be undertaken independently. So now, let me just list some of the project appraisal methods that you may be expected to be familiar with for your exams. So what are those project evaluation methods? I know you already know most of them. So the first is the payback period. So what is the payback period? What's it trying to achieve, or what are you trying to achieve using this method of appraisal? So basically, if you have invested 200 or 2 million naira in an investment and the cash flows for these investments, let's say you are expecting the cash flows to run the inflow, net cash flow to run for, say, 4 years. So in year one, after deducting expenses, if your net cash flow in year one is, say, 600,000, year two, 400,000, year three, 1 million, and year four, 2 million. So how many years will it take these projects to pay back itself? So how many years will it take you to get back 2 million? That is the payback period. So with this illustration, year one plus year two is 1 million, year three, 3 million. So at the end of year three, you've been able to get back your money. So the payback period for this particular investment will definitely be what? 3 years. Okay, so now for the payback period, I'm just summarizing. So for the payback period, you may have even cash flows or uneven cash flows. So if in this example now, these cash flows, they are not even, we have 600, 400, and 1 million, 2 million. So these cash flows are not even. So, but if the cash flow is even, how do you determine the payback period if the cash flow is even? So let me assume that you are expecting 500,000 annually. So if I'm expecting 500,000 annually, how many years will this investment pay itself? So 2 million naira over 500,000 naira. So this will be 4 years. So for an even cash flow, you just do the total outlay divided by the annual expected cash flow that will give you the payback period. Okay. So what if the cash flows are not even? What if the cash flows are not even? What are you going to do if the cash flows are not even? So let's look at a question here where the cash flows are not even. So in this scenario, in this first example, the cash flows are even. Initial outlay is 900 and you expect to receive 300 annually. So the payback period becomes 3 years. But if the cash flows are not even, you need to use a table to arrive at the payback period. So now looking at this example, we are assuming that these are net cash flow after deducting expenses. So if you have this kind of cash flows, you see that it's not even. So what will now be the payback period under this example? So let's look at the initial outlay. So the company expects to spend 100,000 for the purchase of a machine. So how long will it take the company to recoup these cash flows? So there are two things that you need to know concerning the payback period: the timing of the cash flows. Okay, so there are two assumptions, and most of the time, the examiner goes with assumption one. So assumption one is that in year one, the company will be receiving 20,000. So it is assumed that this cash flow accrue evenly throughout the year. So if I receive 20,000 in year one, I'm saying that for every month from January to December, I'll be receiving 20,000 all over 12. That's what I'll be receiving on a monthly basis, right? So let me see what that will give us. 20 divided by 12. 20 divided by 12 will give 1.6. That's 1,666.666. So let me just approximate to this. So what I'm saying is that I'm assuming that every month, this is what the company will be receiving. So at the end of the year, the company will have received 20,000 in year one. So whatever you do in SFM or in your strategic financial management exam, always state your assumption. So if I've solved it this way, at the end of the day, I'm going to state my assumption that I'm assuming that the cash flow accrue evenly throughout the year. Okay, so the second assumption is that the cash flow occur at the end of each year. Okay, but let me just look at this solution before I explain further. So this is the solution. So now we have initial outlay of 100,000 and also 10,000 for working capital. So the total amount spent here is 110. So how long will it take to recover this 110? So this assumed to be the end of year zero. So your project evaluation, you're always assuming the end of the year. End of year zero, what you have spent is 110 at the end of year zero. But at the beginning of year one to the end of year one, you receive 20. So at the end of year one, this 110 will reduce by 20. You receive another 25, it reduced to 65. Receive 35, it is used to 30, it's saved 30, and this becomes what? 0. So at the end of that period, what you have received from year 1 to year 4, which is this period, is 110. So this project will pay back itself after 4 years. So at the end of year 5, these are additional cash flow that the company will receive after the project has paid back itself. Looking at the second example, company ABC is considering an investment in 2 projects, and we assume that the projects are mutually exclusive. So when projects are mutually exclusive, what does it mean? That you cannot undertake A and B. You either undertake A or B. But if they are independent, that means you can carry out both projects if the funds are available. But where the funds are not available, that will now take you to the concept of capital rationing. Or if you are using your Black-Scholes option model, you can delay the projects, or if you can delay the project, you can delay the project. So this is project 1, and this is project 2. So these are the outflows. So this is the initial requirement for project 1, initial requirement for project 2. So what is the requirements here? The requirement is calculate the payback period for each of the 2 projects and make recommendation based on the payback period. Okay. So if you look at it, this is project A. 250 was spent at the beginning or at the end of year 0. This is the inflow, 100, 85, 75, and 5,000. So, but if you look at the first example here, at some point we got to 0. At this point here, we got to 0 at this point here. But if you look at this example on this table, there was no point that there is 0. From negative of 65, so from negative of 65 to positive of 10. So there was no 0. So how do I now know that, okay, it is 3 years, it is 4 years, it is 5 years? Because at the point where I got to 0, I should have said, okay, it is that number of years. But now I didn't get to 0. But the negative ended in year 2. So since the negative ended in year 2, it will now be 2 years plus. Now, how many months are we looking at? Because in year 3, what I received is 75,000. Based on the assumption I said earlier on, that if I assume that this 75,000 accrue evenly all through the year, how many months will it take me to receive 65,000? So you understand that at the end of year 2, what is left for you to receive is 65,000. So initially, the project was 250. Your initial outlay was 250, right? In year 1, you have received 100. You are left with what? 150. In year 2, you've received 85. You are left with what? 65. So in year 3 now, you are receiving 75. That means you have received above 65. So at which point did you now get to 0? So that's, you now say, okay, you receive 75. Before I use the normal formula, let me just do something here. You receive 75,000 in year 2. Okay. So how much did you receive each month? So 75 divided by 12. Let me see what that will give us. So before I show you the formula, so let's see what this will give us. So 6,250 each month. So if you receive 6,250, how many months will it take you to receive 65,000? So that becomes 65,000 divided by 6,250. So let's see how many months that will take. So 65,000, 65 divided by 6,250. So that will take 10.4 months. So 10.4 months. Therefore, the payback period. So at this 10.4 months, that's when it becomes zero. Total amount received equal total amount spent. So this becomes 2 years and 10.4 months. Okay, but you'll not be solving it this way in your exam. This is just for knowledge sake, for you to get a better understanding of what you are doing. So now, this is the way you're going to do it in your exam. At what point did the cash flow become positive? Year 3. So I'll just draw a line in year 2, which is what I've done here. So I have 2 years plus. Now, 65 is what I'm expecting to receive. Okay. 65,000 is what I'm expecting to receive. How much did I receive in the coming year? 75. So it becomes 65 all over 75. So 65,000 divided by 75,000. Let's see what that will give us. 5,000 divided by 75,000. So that gives 0.86666. So this 0.8666 that you got in your calculator, multiply it by 12 to convert it to months. Now it is in decimal places, so times 12. So that takes you back to 2 years, 10.4 months. Okay, so that's just all about the payback period. So the advantage of the payback period is that it's simple to calculate. You don't need any much training to be able to do this. If even the market women, they do it. Those that have a bike, you bought a car, and you give it to somebody, and the person is giving you a particular amount of money weekly, you should be able to determine how long it will take for you to recoup your initial capital, and thereafter, how much will you still make after that. So if you have done that, you just know that, oh, this is a viable investment. So this is the calculation I did earlier on. So, but the disadvantage of the payback period is that it doesn't take consideration of the time value of money. So if you've watched my video on time value of money, you see that 1 naira today is not 1 naira tomorrow. So if I borrow you 1 naira today, by the end of the year, the value of that money will have reduced depending on the inflation rates and the state of the economy. Now, to overcome that challenge, there's what is called the discounted payback period. So the discounted payback period take into consideration discounting. So this is the cash flow table. So before you do your deductions, the first thing you want to do, the inflows, the outflow will always remain the same because year 0, discount factor will be 1. And that will still take you to 100 negative. Okay. So, but for the other year 1, 20,000 is received, it's discounted, it becomes 18. So it is this 18 that you deduct from the 100,000. So everything that you have here is like you're having this 18, you deduct it from this 100. Deduct 20 from 81. So whatever you have, the same way, that's what you're going to do. So the accounting rate of return is the next, and that talks about average profits over a period of time. This is the formula. So this method of project evaluation takes into consideration accounting profits after depreciation, but before tax. So you don't take taxation into consideration using the accounting rate of return. But what you are looking at is average profit. So this is the formula here, average profits. So in this question, the number of years here is 4. So the average profit will be the profit received divided by 4, while the investments, there's a formula here which you may need to look into. Okay, so that's for the accounting rates of return. The next method is the discounted cash flow. So this is where most of the questions will be coming from with regards to investment appraisal. So the discounted cash flow method is very important because the knowledge you have here will be applied in other areas of your strategic financial management exam. So the discounted cash flow method, basically what you're trying to do is to bring the cash flow to present value. Okay. So, and the second method is the internal rate of return. We'll be seeing most of these all through the SFM examination, the net present value and the internal rate of return. You also see the internal rate of return when you get to your valuation, bond valuation. The cost of capital is still the internal rate of returns that you'll be using for that. So, but what's the concept all about? The net present value has to do with bringing a cash flow, a future value to present value. So when you are bringing future value to present value, what are you doing there? You are discounting the cash flows, bringing future value back to present value. So if you are told that in year 4 years time, let me say in 4 years time, you will receive 2 million naira. Discounting this cash flow means that what will this 2 million naira be today? What is the present value? This 2 million here is future value. So what will it be today? So I did a video on that. You can easily watch the video if you are not familiar with discounting and compounding. So in your net present value, you'll be coming across the concept of discounting or inflating cash flows, which is compounding. Okay, deflating of the cash flows to present value is what? The discounting. All right. So for the internal rate of return, what are you looking at? You are looking at the cash flow that will give you, you are looking at the rates that will give you a zero cash flow. So what rates will you discount the cash flow that the net present value will become zero? And what are you doing here? How do you solve this? You pick two rates, A and B, rate A and rate B. You are the one that will decide the two rates that you want to use. Discount the cash flow with the first rate, discount the cash flow with the second rate. But if after discounting the cash flows with the first rates, what are the cash flows that you are discounting here? For investment appraisal, because there are different types of investments. As I said, bond valuation, you have to know the cash flows you are discounting. So for investment appraisal, the first thing you are looking at is year zero cash flow, which is what? The initial outlay. Okay, so the initial outlay, what you are spending is in negative. Then the company may also be receiving cash inflows, both expenses, cash outflow. Now there will be expenses within the period and there will be inflow revenue. But at times your examiner will just give you the net cash flow. So if you are not giving the net cash flow, you deduct the expenses from the revenue to get the net cash flow. So when you have the net cash flow, those becomes your cash inflows for the number of periods that the investment will run. So by the time you bring this outflow and the inflows together for the number of years, you now discount them using a rate. So if after discounting, if you add the cash flows and the outflows and the inflows and you have zero, after using the first rate, then that means that rate is what the internal rate of return. Okay. While you will not need to go to the second rate. But if it doesn't give you zero, it gives you a positive figure. Positive means plus. You have to use a second rate. But the second rate you are going to be using will be increased. If you have used 10 here, but you have positive, you will increase it to another rate. Okay, so basically these are relevant cash flows, your working capital, revenue, all of that. Those are the relevant cash flows. So, but we will not be dwelling on this. So this internal, in my previous video, I showed you the nominal cash flows and the real cash flows. Okay, so, but this internal rate of returns. So basically your examination, the examiner will focus more on the investment appraisal with tax and inflation and working capital. Okay. So the cash flows here relating to tax has to do with your initial outlay, the amount that you used to purchase an asset, which the company is going to claim capital allowance on it, and also your operating profits. The company is going to pay taxes on operating profits if there are operating profits. But if there is no profits, then depending on the way the question is set, the company may be having some reliefs relating to what your capital allowance. So those reliefs will be carried forward to a year where there will be profits. So these are the real cash flow, nominal cash flow, money cash flow. But there is a particular concept that I will just want to emphasize with regards to your investment appraisal. Okay. So, but before I go to that concept, let me tell you that your investment appraisal will come in different form in your exam. It may come as NPV. This is the traditional NPV method. Okay. So this is the traditional NPV method, but your investment appraisal may not come just as the traditional NPV method. So let me just write this here. So we have the NPV method. We have the APV, which is the adjusted present value. Examiner may decide to give you NPV in another way, which you now have to do what? Risk adjustment. Need to do adjustment for risk. So this is where you will be having your beta of asset, beta of equity, and all of that. So these are the basic three forms that it may come. The examiner may decide to still go forward to bring your investment appraiser in the form of what? Not just this risk adjustment now. It may now be sensitivity analysis and uncertainty. Okay. So, but the foundation of all of these other methods is the NPV. So if you understand the NPV very well, it will not be difficult for you to flow regarding the APV, the risk adjusted. What will be different here in the risk adjusted is that you may need to calculate another discount rates. So in the NPV method, your examiner may give you the discount rate that you are going to use. Under the risk adjusted, the examiner will expect you to calculate a risk adjusted discount rate, but the principle still remains the same. Okay, for the APV, here you are separating discounts, the project cash flows into two, the equity side and the debt side. Okay, so these are the basic thing you should be looking at when it comes to your to the investment appraiser. Okay. So let me go back. So basically, these are real cash flows and real discount rate. In this question here, you have a real cash flow and a real discount rate. Okay. Now, what I want to emphasize is this. So further emphasis on your investment appraiser, because there are some things that you may need to be familiar with. Real cash flow, not inflated. Real cost of capital has not been also inflated. So if I have this, I can go ahead to prepare my net present value, assuming that my cash flow is 100,000 and my cost of capital is 10%. So I can go ahead to get the net present value. So I'm going to be receiving 100,000 for the next 4 years. But in a situation where you are giving a real cost of capital and a nominal cash flow, or a real cash flow and a nominal cost of capital, you cannot use real against what? Nominal. You cannot use real against nominal. It must be a real cost of capital, real cash flow, or nominal cost of capital and nominal cash flow. Okay? So, well, now looking at that concept, there's something you need to understand how to grow a cash flow. If I have, now let me start with compounding and deflating of the cash flows. So if you have, in the exam question, the examiner tells you that the company will receive 20,000 annually for the next 4 years. Okay, so this is the cash flow for the next 4 years. The duration is what? 4 years. Sorry, take this off. So the duration is 4 years. Inflation. So inflation is 8%, right? And your cost of capital is, say, 12%. So in this situation, your cash flow is stable. So you have the option of inflating the cash flow annually by 8%, growing the cash flow by 8%. So I can do it in two ways. I can say 1.08. 1.08. This will be year 1, raised to power 1. Year 2 cash flow will be raised to power 2. 1.08 raised to power 3. 1.08 raised to power 4. So that will take me to year 4 cash flow. So year 1 cash flow will be this amount times this. Year 2 cash flow will be 20,000 times this. Year 3 cash flow will be 20,000 times this. Year 4 cash flow will be 20,000 times this. Okay? So if the inflation is fixed, so I'm assuming that this cash flow is real cash flow. And this cost of capital is what? Nominal cost of capital. So I can not use the nominal cost of capital with what? This real cash flow. So I need to do what? Inflate the cash flows. Okay. So now what is the concept of these inflating cash flows and not inflating the cash flows? So what I'm saying here is that at Adventure, you have a business and you are selling a product now for what? 20,000 naira. This product that you are selling for 20,000 naira, if there is inflation of 8%, you don't expect to sell that same product for 20,000 next year, which is year 1, right? And you don't expect to sell it for the same amount all through the years. So if there's inflation of 8%, you want to factor in that inflation in the selling price of that project, of that product. Okay? So you have to inflate it. remember that this cost of capital, we are assuming that it's investors' required rate of return. So let's assume that you borrowed from the bank also at 12%, and there's inflation in the economy. The bank also will not charge you 12% next year, right? The bank will also want to what? Inflate this cash flow, this cost with what? 8%. But now you are giving 12% as what? Nominal cost of capital. So nominal means that this has been already inflated with what? 8%. So you don't need to do any inflation here. But if it was not inflated, you will have also need to do what? Captured in what? That inflation. Okay. So now, this is one way this can come in your exam. The second way you may see a question may be that you may be giving, if I'm giving 20,000 now, and I'm told that inflation rate will differ. Year one, 10%. Year two, 20%. Year three, 30%. How am I going to treat this? It now becomes difference. Okay. So I'm going to solve a question, a past question that has this type of scenario. Okay. So before I solve the past question, let me now show you a final thing that you may need to be aware of. Here, I use 20,000, and I expect that in the first illustration that the inflation rate will be 10% all through. But what if the cash flow, here we have a fixed cash flow and a fixed inflation rate, that's scenario one. Scenario two, you may have variable cash flow that is not even all through the period. This one is even. So year one, you have 20,000. Year two, you have 30,000. Year three, you have 40,000. How do you inflate these cash flows to reflect this growth rate of what? 10%. So what do I need to do? For year one, I will say 10% is 1.1 if I want to inflate. Raised to power what? 1. Since the discount rate is the same, year two will now be what? 1.1 raised to power 2 times this cash flow. Year three will now be 1.1 raised to power 3 times this cash flow. So that gives you the nominal cash flow. These ones are real. We're assuming here zero value. So that will now give you the nominal cash flow. This is scenario two. So the third scenario is a situation whereby the cash flows are not even. Just the way it is now, 20, 30, and 40. So these cash flows are not even. And let's assume that the inflation rate also is not even. Here we assume 10% inflation rate year one to year three. Let's assume that inflation rate for year one is 10%. Inflation rate for year two is 12%. And inflation rate for year three is 13%. How do you inflate these cash flows? Well, I can't do this here, say 1.1 raised to power 1, and I do 1.12 raised to power 2, and 1.13 raised to power 3. If I did it like this, I will be making a mistake, right? So if I say 1.12 raised to power 3 raised to power 2, what I'm saying is that year one year one inflation is 12%. So how did I arrive at this raised to power 2? Raised to power 2 means year one is what? 1.12. Year two is also what? 1.12. So that gives me 1.12 raised to power what? 2. For now, year one is not 1.12, so I can't go this way. So it will be year one, which is 1.1 times 1.2. That will give me inflation for year two. Inflation for year three will now be 1.1 times 1.12 times 1.13. So this will give me inflation for year three, because year one, year two, year three, the inflation rates are what? They are different. Okay, so let me solve one past question, November 2023, professional. Let's look at that question and so that you understand these concepts very well. Okay, I'll just do the A part of it, while on your own, you can look through the B part of it. Okay. So in exam, your ability there are some things that you need to know actually before you get to the examination hall. So, but it's take practice. The number of questions you have solved, you'll have been able to see the pattern, how questions are set, and what you need to do when you encounter such situation in your examination. So look at this question here. It's a question on net present value. Tell us to look at it together and let's see how to approach this question. Senico PLC is a large company operating across the country. It is purely equity financed and has year end of 31st December. Currently, the company has to fulfill a particular contract in Abuja, and it has to do this in one of two ways. Under the first proposal, which is proposal A, it can purchase a plant and machinery, while under proposal B, it can use a machine already owned by the company. Okay. The year end. So before I go to this now, there are two things here. One, the company can purchase a machine and use for the project. The second is that the company already has a machine that the company can use for the project. So if the company purchases machine, assuming that the company purchases a machine for 30,000, right? And the company has this machine here. Now, if the company has a machine, does it mean that the value of this machine that the company has will not be taken into consideration that, oh, because I have the machine, let me just use it to do the project? No, in investment appraisal, you don't do it that way, right? There will be an opportunity cost that is tied to what? To this machine, even though if the company has it. So that cost must be factored into the project. Okay, so this just by the way. So this is information regarding the project. So if you look at these cash flows, projects A has 200, these cash flows are not even. 275 and 350. So these cash flows are not even. But if you look at proposal B, you see that the cash flows here are what? Even 350 and what? 350. Okay. So let's continue. So for proposal A, under this proposal, the company will incur an initial outlay of 312,500,000. That's 312 million. And the date for that is 31 December 2023 for the purchase of plant and machinery. The labor force required under this proposal will have to be recruited locally, and the budgeted wages have been taken into consideration in preparing the estimates of the future nominal net cash flows given above. So I want you to underline this word here, nominal cash flows. That means the figures given are what nominal cash flows. The plant and machinery is expected to be scrapped on 31 December 2026. The nominal, this is also nominal. The nominal cash proceed at the date being projected is what? 25. So all the cash flows that you have seen here, they are what? Nominal cash flows. Okay. So now let's look at project B. That I will just only be looking at, I will only sub project A. So the second proposal covers a 2-year period from 31 December 2023. Sorry, let me take that again. The second proposal covers a 2-year period from 31 December 2023. It will require the company to use a machine which was purchased for, so now, this is what I want you to look at. The purchase price of the machine is what? 750 million a number of years ago. 750 million, this amount is what is referred to as sunk cost. It is what? Historical. Okay? So you just know that this is not a relevant cost several years ago. Okay? So let's continue. A number of years ago and has been fully written down for tax purposes. So there will be no issue of claiming tax benefits on the assets. The company has no current use for the machine, and its net realizable value as at 31 December 2023 is what? 250 million. This is what relevant as far as all this information given is concerned. So this is the relevant information here. Every other thing is what's irrelevant. This 750 here is not relevant. Okay. However, it's retained unused. Sorry. However, if retained unused, there will be no incremental cost of keeping it, and it will be sold on 1 January for an estimated, it will be sold on 1 January for an estimate of 300 million in nominal money term. Okay, so now there's a twist to this, right? So the net realizable value of the assets as at 31 December is what? 250 million naira, right? But we're now told that if the asset is retained unused, that if we don't use it for this project, and it will be sold on 1 January for 300 million naira in nominal terms, that's money terms. If used under the second proposal, the expected residual value of the machine will be 0 at the end of the 2-year period. So what does this connote? If the asset is sold now, you can realize this. Here, 0. Okay? But if it is sold on 1st January 2025, what will be the income there? 300 million. So now, which now becomes the relevant cost? Which one are you going to pick as a relevant cost? The 250 million or the 300 million naira? The cash flow at the end of the year is supposed to be the same as the cash flow at the beginning of the year. So if we have 250 as at December 31, we also expect the cash flow as at January 31 also to be 250. Okay? So that is the ideal situation. But in this situation where your examiner has decided to come this way, what will you now do? Which figure are you going to pick? Are you going to pick 250,000 or are you going to pick 300,000? Okay. So, but you can look at the solution to see what is being done there. Or let me just throw a little light on that. Now, this asset is fully depreciated, right? So since the asset is fully depreciated, it does mean that any amount that is realized from the asset, so we see this as like a scrap value or something based on based on the accounting depreciation. So any amount that is realized from selling these assets will be taxed, will be subject to taxation. So the same thing here, if the company sells this asset at the amount of 300 million, the company will also tax that 300 million. Okay. So after deducting your balancing charge, whatever is left, you compare the two, and that the company will prefer to go with. Okay. But as I said earlier on, ideally, this line shouldn't have been there. Ideally, this should have been the same with this. So, but since you are having the two, you now have to look at the one that will be more beneficial for the company. Okay. So let's continue. The labor force required under the second proposal will be recruited from elsewhere within the company, and in the year-end nominal cash flows, and in year-end nominal cash flows term will be paid 100 million and 108 million respectively in 2024 and 2025. However, so this nominal cash flow also, okay. However, the staff that would have to be taken on in other departments to replace those switched over the new project would in corresponding year-end, let me take that again. However, the staff that would have to be taken on in other departments to replace those switched over to the new projects would in corresponding year-end nominal cash flow terms costs 110 for 2024 and 118 million for 2025. Okay, so what this means here is that these new projects will involve moving staff from an existing department to the new project, Project B, right? And also, at the same time, these staff that have been moved from these departments will need to be what? Replaced by new staff from outside the organization. So those staff that will be employed to replace these new staff, this is what the costs, this is what the cost of their engagements will be. So let me take that again. Replace those switched over to the new project will, in corresponding year-end, nominal cash flow term cost 110 in 2024 and 118 in 2025. Okay, but look at what those staff initially supposed to cost if they are still in their departments. If they are still in their departments, the costs that the company will have incurred will have been 100. Okay, for 2024 and 108 for 2025. But now that we are moving them to these new projects, the company will now need to incur additional 10 in 2024 and additional approximately 10 also in 2025. So that additional cost will be a relevant cost to these projects. Okay. So now let's look at the year-end nominal net cash flow will be 350 million for both years. I think that was stated earlier on, which are associated with the second proposal after deducting the remuneration of the workforce actually employed on the scheme. Okay, so what they are saying is that this 35 million, 350 million rather, the workforce, this 100 has been deducted, and this 108 has been deducted in arriving at this. But this opportunity cost here of 10 million has not been reflected on this. So working capital. Working capital requirements in nominal terms at the beginning of each year are estimated at 10% of the year-end operating net cash flow referred to in the table above. The working capital fund will be released when the project is completed. So working capital here is estimated to be what? 10% of the initial fund. So now the question you may want to ask yourself, this working capital here, does it relate to project A and project B, this information? Okay, the answer would be yes, because definitely since it is the same project, they will also expect the project to have working capital, whichever method you are using. So the project, the A and B, basically the difference has to do with the labor and what the equipment that is to be used. So if it is for production of maybe a construction project, for instance, you see the same number of cement, iron, and all of that that you are still going to use for both projects. So this working capital information should cover both projects. Okay. So finally here, we have inflation rate. So if you look at this question, we have different inflation rates for each of the years. Okay. The company rate cost of capital is 10%. Now, remember that we were given nominal cash flows. Nominal cash flows. Here, the examiner has given you what? Real cost of capital. So, but you cannot use real cost of capital to discount nominal cash flows. I hope you know that already. Okay, income tax is expected to be 40% over the planning period. Tax being payable 12 months after the accounting year end, to which it relates. Capital allowance are available at 20%, so this will relate to only projects A, because project B is fully depreciated, so no capital allowance will arise from that. You can assume that the company generates sufficient taxable profits to relieve all capital allowances at the earliest opportunity. Okay, at the earliest opportunity. So let's dive into the solution of this question. Okay, so these are my inflation rates. Year 1, 10%, year 2, year 3, and year 4. Now, when the cash flow is nominal, that means the cash flow has already been inflated. So there are two approaches to this question. You have a nominal cash flow. In this question now, you have what? A nominal cash flow and also a real cost of capital. But both has to be the same. So it's either you convert the cost of capital to a nominal cost of capital so that you have nominal cash flow, nominal cost of capital. Or otherwise, you convert this nominal cash flow to what? A real cash flow. Okay. But in the solution, what I'll be doing here is that I'm going to convert the cost of capital. I'm going to convert the cash flow rather. Okay. So, but I'm going to be using the real cash flows. So these are the cash flows that I have been given. So these are the cash flows that I've been given. Year one, which is 2024, 200,000, 2025, 275, 2026, 350. And these are nominal operating cash flows. Okay, tax rates, operating cash flows means your profit before tax. Okay, tax rate is given at 40%. And that will take me to my profit after tax. The assets is going to cost 312 million. And at the end of year four, there's going to be an inflow of what? 25,000, which is the expected sales value, residual value of the assets. But first of all, I need to do this conversion, converting the cash flows to what? Nominal cash flow. So for year one, I have 200,000, right? So this 200,000, we are saying it is nominal. That means it has been inflated with year one inflation of what? 10%. So for me to bring it to year zero value, I need to do what? Deflate this figure with what? 10% to bring it to year zero value. Okay. So this is very easy. So I will just have 200,000 times 1.1 raised to power minus 1. That will take me to year one value. So remember initially, I told you that if you have different inflation rates, year two, we have a different figure entirely. And we have a different inflation rate entirely. So I cannot do 200,000 times this raised to power minus 2. No, it will not work. Because year two is 275,000. So I cannot do times minus 2. So if I'm doing raised to power minus 2, what I'm saying is that year one inflation is 1.1, right? And year two is also what? 1.1 minus 1 minus 1. So that will, if I multiply it will take me to minus 2. But in this situation, year two is 1.08. 1.08. So how do I get the adjustment factor for year two? Okay, so let's just come into year one. Is always the adjustment factor for year one is always 0. So we have year one, discount rate or inflation rate 0. So in my previous video, I say your compounding or discounting, year 0 is always 1. So you are not doing anything, you are dividing still by 1. So beginning of year one, will still be what? Will still be 1. Okay, so but the growth rate for year one is 10%. So my adjustment factor will be what? 1.1. So at the end of year one, I'll be having 1.1. So beginning of year two, I'm having 1.1 at the beginning of year two. But the inflation for year two is what? 8%, which is 1.08. 1.08. Okay, so what I've done here is that I'm saying year one, 1.1 times year two, 1.08. So that gives me what it will be at the end of year 2, which is 2025. So the beginning of 2026 will be the same as what 2025. So what is the inflation for that year? 6%, so 1.06 becomes what? My adjustment factor. So what I'm doing now is that I'm inflating the adjustment factor. Okay. So at the end of 2026 and beginning of 2027, we have this, and the final inflation rate is 1.05, 1.32. So what I've just done here is to, normally, as I said, I would have done 1.1. I would have done, for year 1, I would have done 1 point, year 0 will be 1.0, year 1 will have been 1.1 raised to power 1. That will have given me 1.1. Okay, so if the inflation rate was the same, year 2 will also be 1.1 times 1.1, which is 1.1 raised to power what? 2. Is that correct? So this is what I will have had at the end of year 2, 1.1 raised to power 2. So let me see what that is going to give me, 1.1 raised to the power of 2. Okay, 1.1 raised to power of 2 will have given me 1.21. This will have been 1.21 instead of 1.19, because inflation is 10%, 10%. But if you look at the inflation in subsequent years reducing, this becomes 8%, 6%, and 5%. Okay, so this will have been 1.21. This year 3 will have been 1.1 raised to power 3, and so on. So now I've gotten the adjustment factor. So what do I need to do now is to now go and deflate those cash flows, bring the cash flows towards year 0 value. So these are my adjustment factors. Okay. So I need to deflate those cash flows with this adjustment factor from year 2024 to 2025. So these are the adjustment factor that I've gotten now. So deflating the cash flows means that I'm reducing the cash flow, right? So I told you that anytime you are inflating, you are multiplying. Anytime you are deflating, you are dividing. So deflate this cash flow. So do the same for everything here. So this is what the deflated figure will be. So now this deflated cash flow is now your nominal cash flows. Okay, sorry, before I do this deflation, let me take my tax. Sorry, let me bring this figure here. Let me take this off first. Let me take tax so that I will know that I've got into my profit after tax. So tax rate is 40%, which is equal to this multiplied by this. So that is the tax rates. So I need to lock the cell. So this is the tax for the period, but we're told that tax is charged in arrears. So the tax for 2024 will be charged in 2025. Tax for 2025 will be charged in 2026, and tax for 2026 will be charged in 2027. So I need to add one additional year to get that. Okay. So what will now be the after-tax cash flow? I want to ensure that every expenses has been captured. So this will be my after-tax operating cash flow. All right. So now, the next, we still have the assets, which is 3.1 million, and the scrap value will be 25,000 at the end of the year. So let me do the calculation for the tax benefit on the assets at 20% reducing balance. Okay. So what this is the calculation here. But let me just repeat what I did so that I'm assuming you already know this because it's a revision class. So the cost of the asset is 312. Let me take it off from here. So the cost of the asset is 312. And tax depreciation is at the rate of 20%. So tax is at the rate of 40%. So your tax savings will be at the rate of 40%. Okay. So tax depreciation for year one will be 312 times 20%, which is 62,400. So tax rating down value at the end will be 249. So, but you observe that I'm using year zero here. Okay. So whatever you are using, you have to state your assumption. Because normally you take your tax depreciation from year one to the end of the project. But in the question, we're told that tax depreciation will be claimed at the earliest possible time. So since the asset was bought on 31 December 2023, based on your examiner's view, the examiner decided to take the tax as at 31 December 2023, which is when the asset was bought. Okay. So whatever you are doing, you always state your assumption. You're assuming that the assets tax depreciation will be claimed in the year of what? Acquisition. Okay. So that's what is done in the question. So this takes us to 249. The next year, tax depreciation will also be what? 20% or 0.02, anyone you want to go with. 20% of this amount. Since it's reducing balance, the percentage will always be on the tax rating down value of the previous year. So 20% times this amount. So this is the tax depreciation for that year. This is the capital. So just copy this formula down, bring it here. Copy the same formula down, bring it here. So what I've done is to say 249 times 20% gives me the tax depreciation, which is 49.20. Then the tax rate, 49,920 times 40% will give me what? The tax rates or the tax savings for the year. 2024, what will now be the tax rating down value? It will be what it is in 2023 minus tax depreciation for 2024. So this is the tax rating down value. So tax depreciation for 2025. Tax depreciation for 2024 will be this. So I'll just copy the formula and drop. Then get my tax rating down value equal this minus this. Okay. So the final year, we're told that the assets will be sold for 25,000. 25,000. So what will be the balance there? This minus this. Okay, so I'm assuming you already know how to do this. Okay, so I'm not going into much details about the calculation, but the only difference here is that the capital allowance started from year zero instead of from year instead of from year one. Okay, so that's just the only difference here. And the project is expected to run for, let's go back to our table. So basically, the project is expected to run from 2024 to 2026. So at the end of 2026, that asset will be sold. Okay, so now if you look at normally your last year, which is this 2026 year, the scrap value as at 2026. In 2026, you are not doing, so let me just put 2026 here, so that to come able to be clear. 2026. So in 2026, you are not doing tax within that value again in 2026 because that's the year the asset will be sold. So you just sell it and look at whether there's a balancing allowance or a balancing charge. Okay. So this is what we have for year one, year two, year three, year four. So let's go to the table. Let me bring the figures closer. Okay. Tax benefit on assets. That's year one. This is year two. There's the third year. And this is the final year. Okay. But we have this starting from year zero. Okay. So the timing is year zero. Or let me bring it here first so that you understand. So this is the timing. This is what we calculated earlier on 2026. But tax is paid 1 year in arrears. So year zero tax will now be paid in year one. So year zero tax paid in year one tax paid. So this is the way it's going to, it will move. Okay. So working capital will be 10% of sales. I've calculated that year earlier on. 10% of 200, year one, year two, year three. For the timing, this amount will be needed in year zero. So there's a difference here. 27 minus 20, 7.5. This minus this, also 7.5. So if I sum the aggregate of this to this, will give me 35. So my working capital becomes from year zero down. So this is the working capital. Then, having done that, what will be the net cash flow? What will be the net cash flow? So this will be my net cash flows. I put it down here. So this is what I have as the net cash flows for the period. But these cash flows are still what? They are still nominal. They are still nominal. Nominal net cash flows. So these cash flows are still what? Nominal. So I cannot discount this cash flow now with 10% real discount rate. So at this point now, I want to convert this nominal cash flow towards real cash flow. So I need to deflate. So this way I will now deflate the cash flows before I discount. So discounting the nominal cash flows to real cash flows. So at this point, I can do two things. Either to go and convert my discount rates to a nominal discount rate, then I discount. Or I deflate the cash flows and use the real discount rate. So which is what I'm doing here. So year one will still remain year one. I'm not deflating. So year one will still remain at this amount, and just say this divided by this to give me a wrong formula. Okay, sorry. So yeah, 1 is 1. Okay. So yeah, 2, because of inflation, it has increased to 1.10. So let me just draw the formula, drag it. Okay, so if you are solving in your exam, at times you may need to be careful. So already here, I've arrived at what? My operating cash flows. I've deducted tax. So let me underline this so that you won't mistakenly add it. So you just underline, draw a line there. Okay. To show that that aspect of your computation is closed. So I will need to change the formula here. That my addition will come from here. Okay. All right. So now I've deflated the cash flows. This is my net cash flow, nominal cash flows. So this is the deflation rate that I calculated, adjustment factor. So I've deflated the cash flows. And this is what I have after deflating the cash flows. So now I need to now discount the cash flow using the discount rate of 10%. This is my nominal discount rate, 10%. So year 1 will still be what? 1. Year 0, sorry, will be 1. Year 1 will be 1.1 raised to power minus 1. One point one equal 1.1 raised to power minus 2 equal 1.1 raised to power minus 3. 1.1 raised to power of minus 4. Okay, so let me make everything to be in 4 decimal places. All right, so what will be my final figure? Equal this multiplied by this. So that's my final figure for year 0. I can drag this down. So that's my final figure for each of the years. So what will be the net present value? So the net present value is the summation of these figures. This is 136. I can just bring it here. Net present value. So the NPV. So this is the net present value. So this is the net present value. So at these points, what I said is that you can deflate the nominal cash flow to a real cash flow, or you can also decide to do what? Deflate your discount rates. So if you are actually using a real cost of capital or a nominal cost of capital, depends on the cash flow. So in the first part of the solution, I deflated the cash flow so that the cash flow becomes a real cash flow, and I discounted it using a real cost of capital. So basically, for your formula, converting real cost of capital to money cost of capital, you have a formula like this. So let me expand this. So you have a formula like this. 1 plus money cost of capital is equal to 1 plus inflation into 1 plus real cost of capital. Okay, so in a situation where the inflation rate is constant, you are going to use this formula and you are going to have just 1 cost of capital that you are going to use to discount the cash flow for the given years. But in this situation, the inflation rate is not constant. You have 10% in year 1, 8 year 2, 6 and 5%. So how do you solve this kind of question? That means you need to have the cost of capital will be different for each of the year. So in 2024, beginning of the year, the cost of capital is 10%. Okay. And inflation, which is the adjustment factor here, is 10% for that year. So at the end of the year, this becomes 110% times. Let me take this off so that it will not confuse you. You'll be able to see what I'm doing. Okay. So let me take this off. So these are the various inflation adjustment factor. Year 1, 110%, 1.08, which is inflation for year 2, 0.6 inflation for 2026 and 2027. So at the end of year 1, what will be the adjusted cost of capital? It will be this multiplied by the inflation rate. So the adjusted cost of capital becomes 11%. So this will be the beginning for 2025, 11%. So at the end of 2025, the adjusted cost of capital will just simply be 11.88. So this becomes beginning of 2026. And at the end of 2026, this will have changed to 12.59. Then the same thing here. And at the end of 2027, it will have changed to 13.33. So these are the adjusted cost of capital. You get the word I use here, adjusted cost of capital, but it is not the nominal cost of capital yet. I've just really adjusted it for inflation. I'm going to do a video on this, a separate video that will explain the concept of this. But for now, just know that the first thing you need to do is to adjust the cost of capital. After that adjustment, what do I need to do? I need to add the inflation to it. It's after adding the inflation that it becomes what? The nominal cost of capital. And these are the various inflation. So I'm adding inflation to the adjusted cost of capital here to get the nominal cost of capital. Okay, so if I add inflation to this in the first year, 2024, nominal cost of capital will be 21%, 20% in 2025, 19 and 18. Okay, so this now becomes your cost of capital. So how did I arrive at this figure? Is 1 plus R. So this your figure is just your normal cost of capital using 21%, which is 1 plus R raised to power minus n. So that's how I arrived at that figure. So if you do it for year 1, year 2, and year 3, you will have the same result. So this figure here is 1 plus R is 21%, so 0.21. raised to power 1 minus 1. So that's how I arrive at this. So you discount the other year, this one with 20%, 19 and 18%. So after you might have done this, now there will be no need for you to deflate the cash flow because this is your nominal discount rates, and this is your discount factor.